Hi, I'm Anand Subramanian, Managing Director at Macquarie Capital. I'm joined by Ravi Viswanathan, who's the founder and managing partner of NewView Capital. NewView is one of the most interesting recent fund launches as we see the venture ecosystem evolving significantly in response to the needs of private companies. So Ravi, thanks for joining today.
Thanks for being here.
Why don't you tell us a little more about NewView and its thesis. You've spent over 20 years in venture capital and have seen the ecosystem evolve. What was the thinking and strategy and catalyst behind the launch of NewView?
Yeah, sure. So this is my prior firm, New Enterprise Associates. I'd been there 15 years, and as a general partner group, we were really thinking about trends in the industry, and these are really secular trends, not cyclical trends. The number one being the fact that companies are choosing to stay private longer. So you have that dynamic with all the capital coming into the market, companies staying private longer. Also, our desire to actually actively manage our portfolios a little bit better. And what we found were a really high quality set of companies that were either in older funds or where the original partners may have left, or there were reasons why it may have made sense to spin them off into a different asset, into a different fund, and have them be monitored with a fresh pool of capital and resetting the clocks, if you will. So we started thinking through that, and that's when we got to this highly curated basket, and that really was the birth of NewView Capital. And it's just a response to, again, as I had mentioned, a trend that we think is going to persist for quite a while in venture.
What do you think about, what are not only the capital, but the resources and how you think about supporting your companies over the next several years as they reach almost effectively a public scale, but still being private companies?
Our portfolio is generally growth equity scale companies. Are scaling really nicely. Some of them do need more capital. Some of them are on the cusp of going public or being acquired. Mm-hmm. Some need a little bit more time. And it's just a collection, it's a highly diversified pool. And really the resources it's a more focused approach. And the resource will be capital. Obviously, a lot of these companies will need follow-on capital. Company building, we're still company builders at heart, growth equity investors, and that's really thinking about team, product market fit, strategic introductions, and really it's carrying these companies the next phase on their journey, whatever that could be. Growing, and then it could be a standalone public company or be acquired and be part of another entity.
And you all obviously raised a multi-billion-dollar fund with brand new LPs committing new capital, right?
Yeah.
What was the dialogue like with LPs as they looked at something that isn't necessarily venture,
right.
It's not public,
yeah.
It's something in the middle but can represent an interesting risk-reward return for them. How did that conversation go?
It was a great set of conversations. We had to get comfortable internally at NEA that we wanted to do this, and really it's always about the company. So we also went to all of our companies saying, you know what, does this make sense for you? And after detailed discussions with all of them, generally they came back very excited. And then we went to our existing LPs and they thought it was a great idea. It was getting liquidity faster than they normally would have seen. It's a way for us to actively manage our portfolio and cull the portfolio. And then when we looked at new investors, there was actually a lot of overlap. But for the new investors, for them it was actually a very novel approach to venture, a novel approach to growth, and also a novel approach to what they were seeing, a similar trend, which is this whole idea of companies staying private longer. So at least the feedback we'd gotten, it was pretty novel, it hadn't been done before. And once we were able to share with them our thesis, our vision, how we were going to help the companies, and also had them see the companies, they saw that they were really high quality, scaling businesses. They got behind it, and really lucky to have a great group of LPs behind us.
Let's fast forward maybe 10 years, right? Companies are staying private even longer. That effectively NewView 3 is a replacement for the public market, where companies simply function as private companies and investors want to be behind them for 5-10 years, and they own them privately versus traded publicly.
Yeah, it's a good question. I don't think we'll ever be a replacement. I mean, I think fundamentally our job as stewards of other people's capital is to build companies, grow, and exit them and make a return. Mm-hmm. You know, of course, NewView has done that for my former firm's LPs. I do think that the public markets is really important because it's the institutional backing and the markets, capital markets saying this is the value of this company, and for shareholders and investors for them to make a return. I think that the public markets will continue to have their trajectory. There'll be good periods and bad periods. Hopefully the next few years we'll have a good period. I can see, instead what I can see is there's more of what we're trying to do out there.
Yeah.
It's not just a unique thing, it just becomes more mainstream that as you grow, as a company grows, you have several options. You can go public, you can sell, or if you need more time to really capitalize on your vision, you can actually think about trading some of your investors for a new set of investors that step into their shoes and help you grow with the reset clock and more follow-on dollars. That's our hope, and that's what we think will happen. But I think there's no substitute. If you really want venture capital to be a high-quality, high-performing asset class, the public markets, for us at least, that's what is the catalyst that really spurs the M&A markets. It spurs a lot of other things affiliated with it. So,
yeah. When you entered venture 15 years ago, right, venture companies basically went public, and the growth side of the business really wasn't nearly as evolved as it is now, where you've got a whole growth capital ecosystem. You could see a later stage capital ecosystem developing as well.
Yeah, and it's interesting. Right now, the distance or the time until a company goes public is over 10 years. Just 5-6 years ago, that number was below 7. So that number is already, just in a very short period of time in the grand scheme of things, number has already gone up pretty significantly. And now you do see a lot of entrance into the growth equity investment environment. And you just saw the amount of capital that's gone into venture. At least 2018 has been over 100 billion, so there's a lot of capital. I just think what we're trying to do is we're trying to be a really good partner in the whole ecosystem. First and foremost to the entrepreneurs to help them scale. Also to venture firms, but also to the LPs, and try to help restore some of the equilibrium.
Last question. You left NEA, great brand name, bigger firm, probably don't have to do a lot of fundraising or investor relations to your own firm, 6 people. How's it been? What are any unexpected experiences you've had?
Well, it's true startup life.
Yeah.
I mean, it's a new firm. We've got a lot of assets. We've got a lot of great companies. But a lot of my CEOs are laughing because I'm the one now getting up in the middle of the night freaking out about. Yeah, exactly. And I'm head of investor relations. But we've built a really strong team, a bunch of folks that I'd worked with in the past. That's helped a lot. So it's really a team effort. And NEA's been an amazing partner, and they will be. So I have close collaboration with them. But it's been really exciting to be trained at a long-standing venture firm and have the ability to spin out and do our own thing in a interesting small platform that we hope to grow.
Great.
Excellent.
Thanks for joining us.
Thank you.